Hello guys, welcome to the Trading Parrot. I'm gonna do the general markets update looking at Tesla and other stocks that were pumping yesterday. This is how the market closed. We continue declining on gold, and I have to look as well at dollar, what's going on at the moment. S&P entered straight to liquidate the first initial level on the daily. There are two leftover levels that we need to cover. Guys, if you like this type of content, make sure that you are subscribed to the channel, hit the notification bell to get notified every time I put out one of these videos. We can see Bob Lucas is saying that gold is in a corrective phase of the cycle. Don't think this is a fresh buy until January. More for traders, as long-term holders don't give up positions on this. Interestingly, there is an ascending channel in here and we exit from the top there. Obviously, coming back inside that parallel channel could mean continuation, or in my opinion, maybe thanks to the bearish cross incoming on the stochastic RSI applied to the weekly, maybe a more decent pullback, not necessarily just into the middle of the channel, just my opinion. Charlie Bielo is saying that the Fed is cutting rates into 4% average inflation since 2020. Their 2% target is a fairy tale. They printed trillions and the bill is still coming due. If they had any backbone, they'd be hiking rates this week instead of reducing. People are no longer trying to anticipate whether there is a cut or not, but having a second thought on what kind of healthiness we have that we are being forced to cut, since initially what they wanted is to achieve that 2% target. And one of the things that could be forcing as well the hand of the Fed to cut, and not just 25, but maybe a double cut with 50 basis points, although the probabilities is low for this instance, is what could hit the markets next when it comes to jobless claims. Amazon is cutting 30,000 corporate jobs in one go. Accenture is 11,000, General Motors, 200 people, NBC, Meta, F5 Networks, Oracle. You get the point. Pretty much every single company associated with tech are cutting jobs. This could be interpreted as, well, AI is taking over, or it could be interpreted as a slowdown in the demand or in the production, which could be early indications of something smelling burnt as well. But what can we expect based on past performance when we get a cut of interest rates with the S&P 500 within 2% of an all-time high? Very interesting question to put on the table. And the good news is that pretty much a year after, you get 21 times that you are priced higher. You can see the distribution here. Maybe the next month is not great. In the next 3 months, some instances are still in the red. After 6 months, some others, but after a year, you get a steady increase. And I don't know if you have noticed, but the Shiller PE ratio is an extremely value today. We are getting a reading of 41 for the first time since the year 2000. And don't tell me you don't know what happened in 2000 at that point. Of course, we can get slightly higher in here. I think it reached 44 in 2000. But it doesn't need to get there to get a recession just by itself. For example, in 1930s, we reached over 30, maybe a 32, and that was enough to produce the worst recession in history. The total put-call ratio falls to its lowest level since 2020. The bulls are going for it. You can see that it's reaching 0.62, very similar to around that time. Hedge funds have been net sellers for 9 of the last 10 weeks. Positions is defensive, cash levels are high, and conviction is nowhere to be found. The smart money, quotes, is still sitting on the sidelines waiting for confirmation while the market keeps grinding without them. People that are responsible for allocation of stocks, particularly, I was reading the past week that they are performing terrible. They're missing on all the move to the upside. 225% market cap to GDP on today's close. Core inflation above 3%. The wealth gap is widest in our lifetimes. Financial conditions as loose as a wild squirrel. Retail chasing with 3x, 5x leverage ETFs. Time to end QT and begin a new easing cycle. The absurdity of it all. It's impossible to blame the hedge funds. With these conditions, the risk is very extremely elevated. And now there is optimism with all these new bullish catalysts that we got this week. One of the ones that is resonating the most at the moment, Axel says, is the US-China deal that has weakened the dollar's safe haven appeal, while a likely 25 basis point rate cut by the Federal Reserve on Wednesday, that is today, later, further boosts the dollar's decline. We need to look into the dollar, gold, Tesla, and a few other charts today. We look into liquidation levels as well to do a bit of cheating. But before that, we need to see the summary of all the macro elements that are impacting the most price action, or could impact the most price action from the past 48 hours to 24 hours. If you are interested to trade not just crypto, or if you want to have some trades here and there, not just in crypto, a great opportunity is to open an account on VT Markets. You can just transfer USDT in and out from your exchange of crypto into VT Markets, get exposure to commodities, forex, stocks, funds, ETFs, international markets, and everything. And if you use the link in the description, you get a 100% welcome bonus. There has been a slight increase in the probabilities on the Fed Watch tool from 96 to 97.8. Now we have only 2.2% of a no change. I will speculate that if we got a no change, that will be a disaster to the markets at the moment, a cold shower. And if that happened, that will explain why the Fed has decreased their balance sheet allocation if they're about to do another cut. I'm not anticipating anything because it's impossible to anticipate, but why they took a continuation to the downside in their allocation to one of the lowest since 2023, if they are expecting a rate cut and there are so many macro bullish catalysts coming in. That is my only question. All right, let's look at the macro and then we do all the TA on the stocks and the indices. US-China trade war, of course, they are about to meet with Trump. That is a bullish one, at least it's a bullish catalyst. I don't know if it's going to be a sell the news, depending on how it ends. Remember that with Trump, you can expect any U-turn, any minute, any day, a sell-off or a rip-off, who knows? It all depends how he feels. Fade red cat odds 98%. Well, we know that already. That's another bullish catalyst. The US 10-year yield is a 6 out of 10. Lower yields, easier conditions, but move mute. Equities are in risk mode at the moment. We can see that with new all-time highs on the S&P and the Nasdaq. We continue to liquidate those red levels that we are going to look later in trading different. Let's see which ones are left. The VIX puts a new low. Risk on, earnings, stimulus, help. That's another catalyst as well. Cheaper oil eases headlines inflation and supports the Fed. I feel like we're going to get some news about jobless. There's been partial data due to the shutdown. Everything looks okay. It's a 6 out of 10 for now. But if we continue to hear under the hood so many companies doing layoffs, whether it's because of worries about recession, adapting to those potential conditions incoming, or if it's to do with AI, it really doesn't matter. Layoffs are a symptom of a potential recession and they require urgent rate cuts. And remember, rate cuts, when they are controlled, they are bullish. But if they are as a panic attack because something really is screwed with the economy, it's a symptom of a recession. And when there is recessions, you start talking about lower lows and lower lows. Something big is coming is What this tweet says, global central banks will soon hold more gold than US dollars. It's interesting to see dollar putting some bearish patterns at the moment. We'll look into where we can find support, but at the same time, it's a bit spooky against the dollar to see the actual banks eventually holding more gold than dollars, and the curve doesn't seem to be slowing down. It's kind of the opposite. It seems to be speeding up in that direction. So let's look at some charts, starting with the DXY. The DXY has a clear high in here in the momentum, so it hasn't slowed down. This moves down that we are seeing in the actual dollar is just sideways right there at the neckline. So we don't have a clear signal on dollar saying, yes, this was an ugly rejection, now we're going to break the multi-year support, because that is what I want to answer. Are we going to take down this support multi-year and fall below 96? That will be bullish for risk on assets. No, I don't have that reading yet. I have a fully formed double bottom in here with bullish divergences coming from a falling wedge that is bullish, and we are right there at the neckline for 3-4 weeks, not doing anything towards the next target, which is 101.5. So we cannot say anything about the dollar apart from the fact that the momentum is still intact. Let's go to dollar, let's go to gold, and after this second week of sell-off, we really need to make some reshaping in here in the patterns on the RSI weekly. I have identified this parallel channel that starts from around February 2024. We got some support coming in here with double bottoms, and we have some resistance. Interestingly, if we connect this, it gives us precisely the point of peak of 86 around-ish of the gold. Now, gold is coming back in here into the median, and the support on the weekly is what I care about. I want to know where is the weekly support, where is the monthly support for gold, and get there a range that I'm interested in. Between one and the other is an area of value. That could be value for a dead cat bounce, or it could be value for continuation if the banks continue to transition from dollar more into gold for the first time in history. That support on the weekly is located at 3.818 in the price, whereas the 21 weekly is currently located at 3.572. I'm also interested into what happens if the weekly comes into here, because that should find support at 3.5. At 3.5, we got this structure in here. We spent so long there. Eventually, we had the breakout. So coming in here and do a long wick into there could be one setup that ends up playing out. Of course, impossible to tell. We can see that this candle, the red one, the initial one, had the highest volume that I can find since pretty much bear market in 2022. But that one was in the green, this one is in the red. Anyways, it barely managed to be in the green. But when you get this amount of volume liquidated right there, it means that it should stay there. And when we look in the future as at least a local top in here. If we broke down here and we come back and we do a revenge rally into 60, basically going into the 21 weekly or below and then coming back into that yellow line and testing 3.8 as resistance, that could be the confirmation that we need to say maybe we're gonna go into the monthly support on gold. So let's go into the monthly, because the monthly is potentially building a shooting star in here. We are about to end the month of October, and obviously closing with this long week to the upside is not what we want to be seeing. So if the RSI from the highs of 91 on the monthly, nothing less, comes into support monthly, it's going to meet with 76. 76 RSI at the moment is currently priced at 3,662. Slightly below the targets we were talking about on the weekly time frame. Now, it will be very interesting to see if the monthly does a setup like this, puts a lower high, and then eventually breaks down this line there on the monthly. that could confirm a little bit more the downside to get more guarantees that we could get that. Remember that with banks still buying, unless in the next few days we get some news that they are actually now selling back into dollar, that could bring in some upside again. And it's not just the banks in US buying gold, there's all other countries that are trying to de-dollarize their economies. Yes, the VIX has come back pretty low in here. It can still expand, in my opinion, but we kind of lost that momentum significantly that I was saying, oh, we are getting very, very close to an expansion in the market. Let's see if it holds that 15.9 and we get later another expansion. Nasdaq, of course, doing new all-time highs, pushing into 72 RSI weekly. S&P as well, with pre-market about the same price as the close yesterday, still in the area of the revenge rally. We can see that we took on the S&P this liquidity of 683. The next ones are 707 and 726. Those are on the table. Below the price, the only levels that are substantial enough to be compared with the ones on the upside are located sub $500. From 473 to 420, we could say we got a big chunk there. That is if we ignore these levels that are around half or less what we have on the upside. So it's very easy for the price to just do another 6% up and take all of this. If it goes down 6%, pretty much it barely takes the low of the 10th of October, and even it doesn't hit any liquidity. And that could be the reason why this is also still rallying. So many people that were short, you can see one gen of shorts, second gen of short, and third could all be taken out very easily. And I want to look into liquidation levels of Nasdaq. This is the daily time frame. And we got some bullish formation, by the way, in here. So if I place this line like that, we get some sort of cap and handle with a very small handle there. But the technical target is pretty significant, to be honest. It goes to $721, although liquidity is mostly concentrated around the $500 mark. As we go into $560, we decline very sharply into the 600. The risk at the moment is that 200 level that is pretty far, by the way. It's a 56% downside. So as long as we can break out in here and hold the 464 as a new support, preventing this to turn into the bearish counterpart pattern, which is this double top, then we are good to go with Tesla. But be mindful of liquidity hands. Any push into just taking that and coming back below 464 could be a red warning for Tesla. On Tesla, by the way, at the moment, we are in the area of a breakout, but we are breaking out from 65 on the monthly, which is crazy. The line that defends this, the line that we need to defend, is the lower end of the squeeze. So we are now allowed to break out in here, do something like this, and then continue to the upside. We are not allowed to be pushed back down in here, because that, again, is part of that recipe for a liquidity hand, a bull trap. One of the most important news on Tesla is that the shareholders are going to vote on a new pay package for CEO Elon Musk next month, featuring performance goals linked to stock options and a target market cap of 8.5 trillion. And with the earnings, there was a surprise of 155 billion in revenue, but the actual earnings were slightly below, with 0.058 negative, with just a 10.42%. Focusing just on the weekly on Tesla, I want to find where is the current weekly support, and that is roughly around 58 RSI. So ideally we want to defend the $409 at the moment. I can see why is that, because we are currently in a dangerous area. We are potentially about to form a double top, and we need to prevent that as much as possible. Any move below $409 starting to extend into the 21 weekly and beyond that level is just too dangerously close to say, well, we already complete the double top and we are also breaking down on the weekly. The 21 weekly is currently at $364. Personally, I consider the market just going crazy, and I do not trust all these bullish narratives that are coming in so conveniently all together. I'm happy to be completely wrong on this one, but the risk is just so elevated, probably around the higher risk in history, and from too many areas at the same time. Let me know what you think. Let me know if you are happy to trade under these conditions, if you're managing your risk, or if you're just blindly trading and investing. I'm interested to know. Thanks so much for watching. I'll see you in the next report tomorrow. Bye bye.